All right, so good morning, good afternoon. My name is James Bogart, President and CEO of Bogart Wealth. Bogart Wealth is a registered investment advisory firm. We are fee only. We're true fiduciaries for our clients. We're managing approximately $980 million of client assets. It's about 700 households, roughly. 90% of those are major oil company employees. As I mentioned, we are true fiduciaries. Our core competencies are financial planning, investment management, tax optimization, and tax preparation. We have 16 folks as part of our wealth management and planning team. We've got 4 as part of our tax team. We also have 3 offices, one in McLean, Virginia, one in Houston, Texas, one in the Woodlands, Texas. And our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. Your kids and your parents can be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give your children access to certified financial planners. And one of the calls to action from today's talk is to actually sit down and run your numbers. I think given these uncertain times, it's only prudent to have a plan and be in a position to be able to make decisions relatively quickly. I do think that we're going to continue to see some changes coming. And I think it's important to have that baseline understanding so you know where you're at, where your numbers are, and be comfortable with that. Today's talk is part of really an 8-part series that we do called the Retirement Readiness Series. We do one on presentation on retirement timeline. I did that one last week. We do today's talk on retirement income planning. I do one on Social Security and Social Security strategies. I do one on tax and tax optimization strategies. Do one on estate planning strategies, one on net unrealized appreciation and post-retirement income strategies, one on long-term care and long-term care insurance, and then last but not least is our Roth First Traditional 401ks and IRAs. We've been doing these every week for the most part. They're all recorded. They're all up on our website. If you'd like to listen to any one of them, please feel free to check them out. And for today's talk, I am recording it. If you'd like to get a copy of the slides, we're going to follow up at the end of the presentation and feel free to ask for them and also ask for the recording. Just a couple administrative things. I do have the question and answer box open as well as the chat box. I'll do my best to make sure that I'm answering questions throughout the presentation. And at the end, we are doing a survey. Really do love the feedback, love hearing what we could do differently. Part of these presentations, they're all done based on questions that folks have been asking us to talk about. And even if it's a real brief one and it's something that's valuable to you, please feel free, let me know. At a minimum, we'll add it in to an existing presentation, or I'll just create a new one for it. All right, so today we're really going to be talking about retirement income planning. We're going to get into why it's important. We're going to talk about some of the risks associated with any level of retirement planning. And then I want to get into the retirement income planning process itself. Specifically talking about retirement analysis, some of the things that you should be considering looking at. We're going to get into some basic investment strategies. I'm not making any particular recommendation here, just want to educate on the different options available to you. We're going to talk about some withdrawal strategies, different ways of generating that paycheck, and then some flexibility that you should have or consider related to your retirement plan, and then ways to review and monitor your plan. So let me just dive in. All right, so why retirement income planning? Well, at the end of the day, it's enabling us to plan for and minimize risks. Really all retirees do need to address, but also helping us with making more informed choices. We need to understand and estimate what our expenses are going to be to help ensure that we're going to have a more predictable and reliable income stream. And then also looking at a sustainable withdrawal rate and having that withdrawal strategy that's going to help ensure that your money your money outlives you and that you don't run out short. But then also having the mechanisms in place in order to be able to monitor, adjust, and track, and then adapt based upon the environments that we're in. So first, we need to understand, really creating that vision for retirement. What is important to you? And some of these are things that, interestingly enough, as I'm doing a lot of plans recently, a lot of folks haven't even thought about retirement and what's important to them, how they're going to spend their time. I do think retirement is part financial, but also emotional. And so part of it is understanding some of those key variables. Family, what impact is family going to have on your plans? Health, how are you going to stay both mentally as well as physically active throughout retirement? And do we need to make any changes or adjustments based upon you or your spouse's health into or in retirement, during retirement? Where do you want to live? Do you plan on moving, or do you plan on buying a second home? All of those things are variables. For example, the state that you're a resident in, that could have different material tax implications based upon the one that you're in now. Want to make sure that we're planning for and adjusting strategy based upon those needs. What type of lifestyle do you want to have? What activities are you going to do that are going to provide satisfaction? Do you want to work in retirement? I know a lot of people that ultimately the plan is they don't actually want to stop working. They just want to stop working at where they're currently at. Do you want to leave a legacy? Do you intend to leave money to kids or heirs or even charitable causes? And then lastly, we note, mind and spirit. What do you actually want out of retirement? My dad recently retired. I tease him, he really did spend a lot of time talking about the financial side, but not necessarily the emotional side of it. And now with COVID, it's very difficult for him because, frankly, he can't do a lot of the things that he wanted to do. And I think that part of the planning process itself really needs to incorporate both emotional, but also the financial piece. So we talk a little bit about important goals, and this is an interesting one because we look at a survey that was done, and this is a little bit older now, but frankly, it's still very applicable. But in that survey, it said that 79% of participants wanted a secure, reliable retirement income. 73% said they wanted income that keeps up with inflation. 58% they said they wanted to not worry about having enough money. 22% said that they wanted to be in a position to be able to help out children and grandchildren financially. 19% said that they wanted more time for sports and recreation. 17% for volunteering, 5% for going back to school, 2% for making philanthropic contributions. What's really interesting about this survey is the top three all have to do with money. And I think that's only indicative of what really retirement income planning is. So as we dive into it, we first need to talk about risks in retirement. And one thing you'll hear me talk about over and over again, there is no such thing as a normal retirement. Everyone's going to be a little different. Things that are important to you might not be important to someone else, but there are some kind of key overarching types of risks that we see as we're building out plans. And the first one we talk about is longevity. For the average couple of the age of 65, there's a 49% chance that one of the two of them is going to live to age 90, 20% chance to 95, and a 4% chance that one of them is going to live to age 100. We don't want your money to run out for you. So making sure that we're incorporating strategies that are going to adjust for longevity needs that any particular household is going to have. Inflation. We do think inflation is very, very real. It might not feel real after the last 10 or so years. But truthfully, you look at it, and then you look at the amount of money that's been spent globally over the last 6 months. I do think inflation is becoming a bigger and bigger risk and needs to be adjusted for in a retirement plan. And just to give an example, a 3% inflation rate is going to turn $50,000 in today's purchasing power into $23,880 in 25 years. So that's a real impact. Then we talk about market performance, and this is the one that obviously gives us the most angst, but there's two parts of market performance that really need to be addressed within a retirement plan. The first is sequence of returns, and the second is volatility. And when we talk about sequence of returns, we're really talking about low and negative returns, especially in the earlier parts of retirement. That can have a devastating impact on a retirement plan. You think about it, if you retired in the early part of March, market's correct by 20%, and then you made a rash decision to go to cash and locked in those losses, well, that'll absolutely have an impact on what you're able to spend. Just like volatility, having to sell in down markets in order to generate your paycheck, as an example, that's also a big risk that we want to make sure that's being addressed. And then healthcare. And this is actually specifically talking about long-term care. Healthcare costs have been rising significantly faster than inflation. And, a recent study also estimates that a couple the age of 65 is going to spend approximately $230,000 in retirement to cover healthcare costs. Now, that's an average. That's an average. We've actually seen instances where it's significantly more than that. And modeling and building out a plan that obviously incorporates and adjusts for that is extremely important. So when we talk about retirement income planning, we obviously have to rely a little bit on historical averages to help us forecast needs. But again, there is no such thing as an average retirement. And so really what we've done is we have a four-step approach where we're looking at customizing based upon your goals. We want to include elements of your portfolio structure that's going to provide a level of income that's going to cover all of your essential needs, and then offer some flexibility to adapt to the times. And some of the things we're going to have to look at is your historical spending habits. We'll look at your lifespan of heirs, parents and grandparents. We're going to look at returns, and based on your comfort level with risk, what type of returns should we be modeling within a plan? Taxes, I think that there's a pretty high probability we're going to see tax changes happening. We do know that in 2026, with no type of reform, we're going to see tax changes happening more sooner than later. And then inflation, as I mentioned earlier, I think inflation is a very, very real risk. And so what this looks like, you start out, you talk about retirement analysis, you go into the details of your specific plan. Then you need to adapt and build out an investment strategy. How are you going to have returns that are going to be able to provide the cash flows that you need? Then we need to talk about withdrawal strategies. How are you going to determine that paycheck or create that paycheck for you in retirement? And then lastly, it's in more of the maintenance, the reviewing and the monitoring to ensure that you're on track and that there's not course corrections that need to be happening. So when we talk about retirement analysis itself, this is really the first phase. We need to understand what your needs are, and understanding what makes your retirement unique. And we want to prioritize those goals and set realistic expectations on how to financially achieve them, and really looking at what do you need to be spending. What I do see typically with retirees is there's kind of this period of time as soon as they retire where they're more active. We call it the go-go phase. And then you typically transition over into what we define as the slow-go phase. And then eventually it's more of what we call a no-go phase. It's fairly common. Now, not everyone stays in that no-go phase for very long, or even in the go-go phase for very long. But this is where we need to have those realistic estimates for what are your essential expenses, your needs, versus more of your discretionary expenses, which we would define as wants, and then incorporating unexpected expenses or any type of wealth transfer goals that you might have. And so when we talk about spending, it really is more related to lifestyle choices. So we defined essential expenses, your needs, as food, housing, health insurance, care needs, etc., versus your discretionary wants, which are really entertainment, travel, gifts, country club memberships, things of that sort. And what's always fascinating is to see what potentially a husband and wife categorize. For example, one might categorize a Mercedes-Benz every 5 years as a need, when it really potentially is more of a discretionary purchase. And versus the other spouse might say, well, that is more discretionary. We don't need to be incorporating that in the plan. Obviously, we need to be adjusting and adapting to set aside for emergencies and unexpected expenses. And then we need to be increasing this spending at some level of cost of living adjustment. And here's an interesting survey that was done 2018. It was released in 19. But it breaks down the categories of spending by these different age bands. So it starts by talking about 65 to 74. 55 to 74 to 64, then it goes to 65 to 74, and then 75 plus. And what it's looking at is different categories of expenses. Now, this is based upon the median US household. Now, what you'll notice is that first transition from the first phase to the second, which is kind of more of active employment to retirement, we do see spending overall is decreasing pretty significantly, except for two categories, healthcare and then entertainment. And then as folks age a little bit more, we do start to see everything decreasing except for healthcare. No surprise there. But overall, the trend is down, that overall people are spending less, but that's not necessarily going to be the case for you. And that's why we want to make sure that we're looking at your situation and having those adjustments necessary for it. Then we're going to talk a little bit about inflation's assumptions. We want to obviously look at healthcare. So typically when we're building a plan out, we do assume that healthcare is inflating faster than normal inflation. We want to build in extra costs for later years and consider potentially looking at a long-term care strategy. And maybe that might be we need to consider some type of long-term care insurance. And then what we do is we look at the income sources that you're going to have. So for example, Social Security and any type of employer pension. Then it's going to be looking at different types of savings that you've been doing. And then it might be rental income, business and employment earnings. Next up is looking at inheritance, sale of homes, might be a reverse mortgage, and creating that plan that works. So when we drill in and we talk about those retirement income sources, first up is talking about Social Security. Now we do a whole presentation on Social Security, by the way, but the important thing to know with Social Security is that it was never designed to replace 100% of anyone's income. On the lower end, it was designed to replace approximately 90%, and theoretically less than 1% if you have essentially unlimited income. For the U.S. median income, it does replace approximately 40%. For the typical energy employee household, it's anywhere from 10 to 30%. And here's kind of a quick illustration on Social Security. So for example, if you're able to live on $11,520 a year, Social Security will replace 90% of your needs. If you're able to live at $69,420 a year spending, it replaces 42% of your needs. If you're right at the max Social Security wage base, which is $137,700, it replaces 27%. And as you spend more than that, it's obviously replacing less and less and less. So next up is talking about the pensions. Now, a pension, specifically looking at like the ExxonMobil one, for example, also never designed to replace 100% of anyone's income. On the low end, it's replacing 12%, and on the higher end, it's as high as 65%. But we know the formula. So the formula for the ExxonMobil pension is 1.6 times years of service times average pensionable pay. There's a little Social Security offset that occurs. But what we find is the typical career employee replaces approximately 50% if they're retiring at the age of 60. And just real quick illustration here, this is a little bit of a dated slide here. It's from 2007. But the reason I like it is it shows the calculation itself. So you can get that 1.6 times those years of service times average pensionable pay. Here's that Social Security offset. This gives the single life annuity option. And what we're then looking at is how then to calculate that lump sum value or any of the annuity benefits available to you. And when we look at the design of that pension program based upon your years of service, it's important to talk about how it's accumulating. And this does come into some of the timing and execution decisions that we're going to be making related to your retirement or when we're going to commence the benefits. So for example, if you're retiring right at 55 with 15 years of service, as I mentioned before, it's going to replace approximately 12%. That's on the lower end. And as you get a little bit older, it's accumulating at approximately 5% per year. But again, if you're retiring right at that 15-year mark, it's replacing, ever so slightly amount. But really, for somebody who's retiring over the age of 60, it's approximately a 20% replacement ratio. Whereas for those quote unquote career employees, as they continue to work and accumulate, from 55 to 60, we're seeing approximately an 8% per year accumulation within the pension program. And once you attain the age of 60, it smooths out a little bit. And this is mostly because ExxonMobil is no longer imposing an early commencement discount. But then we're now having about a 3% per year accumulation within that pension program. All right, so real quick, going back to the slide. So let's say, for example, your pension's replacing approximately 50%. And let's say Social Security is replacing 10% of your spending. Well, that's 60% of what you're making now. I don't know a whole lot of folks that retire that all of a sudden want to live on 60% of what they're making. So that's where we then need to rely on savings and other investments in order to offset the differential. And because of that, we need to talk about investment strategies. Now, this is where we kind of transition to the second stage of the planning process. And really today, what I wanted to do was illustrate 5 of the most basically commonly discussed investment strategies for retirees. So we can talk a little bit about annuities, talk about bond ladders, going to talk about more income-oriented types of investments. Then I'll talk a little bit more of a passive fixed asset allocation model. And then lastly, we'll talk a little bit about a dynamic strategy. But really, at the end of the day, the whole purpose of having an investment strategy is to eliminate emotions from having a financial plan. And what we found is that fear and greed can lead to you buying high and selling low. And what we're really trying to do is reverse human nature here, whereas we want to have a disciplined approach where we're buying in lower price points, selling at higher price points. But ultimately, it comes down to having a system and process in place to eliminate the emotional elements of the investment process. So we want to build a portfolio that will help protect from downside, having an income stream in there for those necessary essential expenses, and then employ strategies to help with more volatile market environments, whether it's withdrawal strategies or different types of spending and harvesting strategies. But at the end of the day, we have to have a plan in order to be able to deploy these types of strategies. So in order to do so, I want to talk a little bit about the different investment options. And first is talking about annuities. Now, annuities and specifically talking about annuities that you would potentially buy with your investments, not necessarily the annuity program that's through company employment plans. But with annuities, there's really three different categories of annuities. There's fixed annuities, indexed annuities, and variable annuities. So the easiest way of thinking about a fixed annuity, it's a lot like a bank CD. It's got a fixed rate of return, and all of the funds in a fixed annuity are held in one company's general fund. Then I want to flip over and talk about variable annuities. So variable annuities, the easiest way of describing them is think a lot like mutual funds that have some type of barriers to them. So a lot of these variable annuity companies, they are subject to market rates of return because they're being invested in separate accounts. So all of the money is held separately. However, they do typically like to throw on income riders and guaranteed income benefits and different types of ways to help guarantee your income streams. And then in the middle is what we describe as indexed annuities. Now, an indexed annuity is really a hybrid of fixed annuities and variable annuities. A lot of them are structured where they'll give you a percentage participation with the market with some kind of cap or floor. And indexed annuities also are held in a firm's general fund invested in a common manner. Now, annuities, this is all about risk profile in terms of how much exposure any investor should have to an annuity vehicle. The big criticism with annuities really is their cost. Typically, they're a little bit more expensive when it comes to other options you might have with investment vehicles. But as we go through a client's risk profile and we understand their spending needs, their tax sensitivities, it might be something that we want to consider. But I'll even throw in the ExxonMobil annuity option as a mix. It is something that we could consider as well. And the beauty of the ExxonMobil program is it used to be 100% lump sum versus 100% annuity. Nowadays, you have the ability to do 75-25, 50-50, 25-75. And so if wanting to have a guaranteed cash flow piece into the overall equation, it's not necessarily a bad option to consider. The only criticism I have of the ExxonMobil annuity is that there's no cost of living adjustment. So we need to have a strategy in place associated with how we would offset that type of cost of living increases for those types of expenses. All right. Next strategy we talk about is bond ladders. This is a very, very simple example of bond ladders. This is a 3-rung, 3-year bond ladder over a 6-year period. And the concept here is, let's just say, for example, you have $300,000 to invest and you want it to be more conservative and just have an income stream. Well, for the first $100,000, you'll buy a 1-year bond. For the second $100,000, you'll buy a 2-year bond. And for the third $100,000, you'll buy a 3-year bond. As the 1-year matures, you buy a new 3-year. As the 2-year matures, you buy a new 3-year, and you just continue to ladder it out. Now, by the way, you can do this with CDs as well. The point with this is that it's a more conservative strategy, and you're going to live off the income. The challenge has really been that income from bonds as of late, last decade, has been very, very low. And that in order to get any level of income that's satisfactory for most retirees, we've had to go significantly longer in terms of the time horizon of the bonds we're investing in to get any level of income that a typical retiree is comfortable with. And so to kind of give an example of what some of these income numbers look like, bond ladders can be anywhere from 2.8% to 4.7%. And then we look at like some of these income funds, mutual funds that are of different mandates. So for example, corporate bonds are anywhere from 1 to 2.5%. Some of these flexible income funds are at 5.3%. A mortgage bond is anywhere from 1 to 2% now. Most international bonds really aren't paying anything, 0.1% on the high end. We are still seeing preferred stocks, somewhere around 5.35%. Royalty trusts are anywhere from 7 to 19%, whereas you can get big dividend paying stocks anywhere from 3 to 7% typically. I know ExxonMobil right now is paying a 10% dividend yield. And as long as they sustain the dividend, then that's not a bad income stream either. And we compare all of that to treasury rates at 0.7%. So, again, we need to understand where the cash flows are coming from. But one of the things we also want to talk about is if we're going to go into more of an income-oriented approach, then maybe we should look at ways of diversifying. And so one of the strategies we introduce is comparing ExxonMobil stock, for example, to one of the portfolios that we manage, which is called Prime Income. Now, this chart is a little bit dated because it's obviously not incorporating 2020 and what the stock price has done. Really what we're trying to show here is the value of the income stream, whereas the appreciation off of the portfolio as well. And this is going back till 2000. So you can see the red is ExxonMobil stock. And again, it goes all the way through 2018 versus Prime Income, where it's showing the history of that portfolio, net a 1.3% fee. But the other thing we're going to look at is that dividend income stream. And this is going again all the way back to 2020, where yes, ExxonMobil's dividend was paying a nice generous 2% compared to the Prime Income portfolio. And again, this is in 2000 at 4.8%. And what the blue is showing is the Prime Income dividend yield versus ExxonMobil's. And yes, ExxonMobil's has risen faster over that same time frame. However, it's important to probably note that the stock price has not, and that's the main reason why the dividend income has risen faster than Prime Income's. But I would also say that appreciation from an income-only type of portfolio strategy is also important. Again, one strategy to talk about, but we do like Prime Income. We do like value-based stocks and buying individual stocks where we're able to target that 4 to 4.5% dividend income stream and then getting appreciation as well. It's just one strategy that we'll talk to folks about as we're talking about their overall portfolio needs. And then I'll transition over to talk about more of a modern portfolio theory, fixed asset allocation. And the whole concept here is that you can have a portfolio that's 100% stocks where you're going to have more risk but more return versus a portfolio that's 100% bonds where you'll have less risk with less return. And the concept with modern portfolio theory is that, frankly, you can have a combination of a stock and bond portfolio where you can get a more consistent overall return but having less risk than any one of the two individually. And so the concept here is that we want to have the most optimal rate of return with the least amount of risk. Now, the only criticism that I think with a more passive modern portfolio theory approach is that it doesn't necessarily incorporate the withdrawal needs or cash flow needs that a retiree would have. While someone's in the accumulation phase of life, really do like more passive strategies because that is typically the best and most optimal way of generating long-term returns, but it doesn't necessarily incorporate spending needs. And then the last one we talk about is more of a dynamic approach, and this is where you're making adjustments. And the concept here is that at the start of the 20th century, railroad stocks represented approximately 63% of the U.S. equity markets and 0.2% a century later. Russia, India, Austria, Hungary represented 25% of the global equity market in 1899 and less than 1% a century later. So the point is that things will change and that we're going to also have periods of time where we have sustained drawdowns. And this is looking at history. Now, obviously, we haven't put in 2020 yet because 2020 is not done, but we've seen how we had a sustained drawdown and it rebounded pretty quickly. Now, I would say that with growth for 2020, it's not necessarily an accurate indication of the overall economic environment. However, from a market perspective, we're within even for the year. When we look at these more sustained drawdown periods, like an 07 to an 09 or a 2000 to 2002, where we're seeing 56 or 49% decline rates, well, that's where we typically see investors make bad decisions, more emotional decisions. And the idea is potentially finding ways to protect on the downside environment, but also providing that level of income that someone's going to need in order to be able to sustain their retirement. And so with dynamic, it's a process. It's not a timing mechanism. It's not trying to time the market. It's based on actual trends, not beliefs or predictions. It's looking at relative strength indicators, and it's factoring in geopolitical concerns, economic upturns and downturns, different types of industry or sector opportunities. It's looking at interest rates. It's ranking and scoring all asset classes versus each other. And then that's what then determines what the most optimal asset allocation is for that portfolio structure. And if you look at this kind of illustrative, we call it the investment periodic table, but you can see how asset classes have performed each year. And not every asset class is consistently performed as the top asset class. They change. And so the concept is that we want to adjust where our portfolio structure is based upon what's performing better and what's not. Now, let's transition over and talk a little bit about withdrawal strategies. So withdrawal strategies is really talking about how are we going to create that paycheck for you. So the first is income only. And income only means that we're withdrawing interest and dividends from investments. That's what we're living off of. And then more of a bucket approach is where we set up a withdrawal needs for more of a short-term needs. Then we talk about intermediate term needs, and then we talk about long-term needs, and having different investment strategies for each of those different buckets. And then lastly is more of a systematic approach where we're taking a pro rata withdrawal amount from a very well-balanced portfolio. Each of these has their pros and their cons to them, and it's important to have that withdrawal strategy structured for you and your needs. Now, when we talk about managing distributions, this is really talking about where should we pull from first. Now, general rule of thumb, we typically like to live off of non-qualified assets first. Then we talk about qualified assets. Then we talk about Roth assets. Now, what each of these are. Non-qualified assets are after-tax assets. This is checking account, brokerage account, savings and money markets, things that you've already paid taxes on, but as they're continuing to grow, they're paying dividend income, which is taxable, and you'll have to have long-term capital gains as you liquidate those types of assets. We typically find that that's the most tax-efficient way of structuring your paycheck first. And then we transition over to qualified assets. So qualified assets would be 401ks, it would be IRAs. And then lastly, and by the way, 401ks and IRAs, they are growing tax deferred, but when you take them out, it's ordinary income. And then lastly is Roths. And Roths, they're after-tax money we put in, they're growing tax-free. And when you take the money out, as long as you're over the age of 59.5 and it's been there for 5 years, they're also tax-free. All of the growth is tax-free. So typically, because of that tax-free growth, we want to have Roths be in existence as long as possible. Now, another thing that we need to talk about is how to manage required minimum distributions. This is something we find is a big issue for a lot of our clients. Now, required minimum distributions are when you are forced to start taking money out at the age of 72. It's based upon a percentage of what your account balance is from the end of the prior year. And the big thing here is that it's a 50% penalty for any amount that you miss. So it's kind of religion in our opinion to make sure that we're satisfying our RMDs. But in order to really understand what the impact of RMDs are going to be, this is where we get into a lot of that tax optimization discussion. But it's also looking at current spending versus future spending needs and helping build out those models. Now, one thing to note is IRAs and 401ks and Roth 401ks all are subject to RMDs, required minimum distributions. Roth IRAs are not. So that's another reason why we want to get money into Roths and let them grow tax-free. And this is where we're going to talk about some age 72 strategies in order to help with mitigating some of the longer term impacts of what those required minimum distributions are going to do. And here's just a real quick example of what a Roth conversion type of scenario would look like. And to start, we look at what the RMD tables are. Now, there has been a proposal to change the RMDs, hasn't passed yet, not a huge surprise there. So what we're still operating off of is the existing RMD table, which is saying for an investor who's 72, they're going to have to take out 3.9% of their outstanding IRA account balances. And one thing you'll notice is that percentage increases every single year. If you're able to live to the age of 115, your RMDs are 52.6% of your account. Love to meet you. But for most of our clients, as they get into their 80s and late 80s, those RMD percentages start to get pretty steep. And what it's doing is, because we're pulling money out of qualified accounts, it's pushing your tax brackets up. And so for a lot of retirees, what we find is that there's this period of time right when they retire where their taxable income, their marginal tax rates drops pretty dramatically. And it goes back to that sequencing of spending. So it's non-qualified assets, then qualified, then Roth assets. But if you're in the position where you're going to be in a very low tax bracket for a period of time, well, this is the time that we want to look at doing Roth conversions. And here's just a real quick example of one. where this household was going to be in the 12 and 10% bracket for the first phase of their retirement, but quickly moves to the 32%, 35% brackets as they got older. And really what we're saying is, let's consider doing some conversions now, moving assets from the IRA accounts over to the Roth IRA accounts, so that not only they can grow tax-free for the rest of their lives, but also so that they're not subject to the math of the RMDs. And with doing this, it's actually bringing down their effective tax rates dramatically for a majority of their lifetime. So it's a strategy to consider, especially as you're building out a plan, but something I'd also encourage any advisor that you're looking at working with. They need to understand the nuances here. That's also why we believe it's so important to integrate a lot of tax, because the ultimate goal and objective is to keep more money in your pocket. And with doing so, we need to understand the tax implications of the different buckets that we're pulling money from. So Social Security, typically it's 85% is taxed as ordinary income. Pension income, interest income, IRA and 401k distributions, all taxed as ordinary income. Dividend income as well as long-term capital gains are going to be taxed at capital gains rates. I'll come back to that in a second. And then Roth IRA is not subject to taxation. So is liquidation of any investment principal, also not subject to taxation. So again, incorporating all of these, but knowing what the tax implications are of where we're generating our paycheck from. And so along those lines, when we talk about capital gains rates, so we know that ordinary income rates go from 10% to 12% to 22% to 24 to 32 to 35 to 37%. But capital gains rates actually go from 0% to 15 to 18.8 to 23.8. And so the concept here is as we're building out your paycheck and understanding your cash flow needs, there might be an opportunity for us to stay in the 12% bracket once you've retired. And if that's the case, and you have some highly appreciated stock positions, it might be, for example, if you have some NUA shares. I know ExxonMobil stock is down from where it used to be, but a lot of our clients still have gains off those NUA shares. Well, if we can find a strategy to sell them and pay 0% capital gains rates, well, that's not a bad strategy to look at too. By the way, it doesn't necessarily have to be ExxonMobil stock. You could have other stocks that you've been investing in. But even so, along the same lines, let's say you might have a year where you're just jacked up tax-wise. You're in a higher tax bracket for whatever reason. You sold something, or you had a supplemental or additional payments plan come out, and you might be in a high tax bracket. But the year after that, you're going to be in either the 15 or the 18.8%. Well, that's something to consider with regards to timing of when you're going to generate your paycheck. All right, so then we transition over into more of that maintenance mode, reviewing and monitoring. And this is where we need to have a plan for our plan. The concept here is doing all of this planning work. It's great, but if it never comes back out, then what was the point of it? You just do the plan and then put it on the shelf. Well, really, why did we effectively need to do it? And I think any advisory firm that you're working with also needs to assess performance relative to a plan. Now, by the way, performance isn't just how your portfolio has grown. It's spending needs. It's looking at assets. Have asset values, but are they higher or lower? Has your income been in line with what we projected it to be? How is your spending? How is your portfolio? How have you been doing with your withdrawal rate? How is that impacting? We want to look at it when inflation's done, and then looking at overall goals and expectations. Has anything changed in retirement? And so when we look at withdrawal rates, this is an interesting chart that we use essentially as a baseline. But what we did here is we said if your investment returns were 5% and inflation was 2%, so really what that's saying is you have a 3% real rate of return. Well, if your withdrawal rates are at 3%, so meaning you have $1 million and you're only pulling out 30 grand, well, if you're at 3%, then theoretically it looks like your portfolio is going to last forever. It's not quite the case. It actually runs out in about 99 years. But for most retirees who are retiring at age 60, for example, 99 years is probably more than enough time. Same goes with a 4% withdrawal rate. So 4% withdrawal rate, that lasts for about 43 years. 5% withdrawal rate lasts for 29, 6% for 22, 7% for 18, and 8% lasts for about 15 years. So understanding what you're pulling on your portfolio and what that does in terms of the longevity and survival of that portfolio. So when we talk about creating that retirement paycheck, we need to obviously start with a reasonable withdrawal rate. We want to build a foundation for those essential expenses and have withdrawal strategies for all of our discretionary expenses. We want to have a diversified portfolio management approach that does provide some downside protection. And then we want to implement various different spending and withdrawal strategies that are going to help us cover the essential expenses, but that's going to be what ultimately does dramatically increase the probability of success for the longevity of your retirement plan. And so when we talk about spending strategies, this is where you really understand that one of the things that I see happens a lot is, let's say we have a great year. 2019 was a great year for most people's portfolios. Well, the temptation is, let's go spend some more money. I think that's great, but I do also ultimately think that we need to have some type of guidance or parameters to prevent us from overspending. So maybe, for example, you increase your income by inflation with a cap of 6%, for example. But if you have a bad year, then maybe we don't increase our spending that following year. We help with absorbing some of that by not having inflation adjustments on what we're spending. And then when we talk about withdrawal strategies, you know, income and dividends that come in, those should be the first place that we're pulling money from. But then we also need to understand how we're going to withdraw from the portfolio for anything after that. So first, we typically look at assets with positive returns. We begin with stocks, and then we move over to bonds. Next up, we look at cash positions. And then last is where we look at assets with negative returns. First, we look at fixed income bonds, and then we look over at stocks. So the concept here is the things that are going to perform better long-term, let's give them more time to catch up. So really, a lot of this at the end of the day is a long-winded way of saying you need to have a plan and have a plan that's able to adapt and adjust for changes that are going to happen within the market environment. Now, I do think that if you're going to consider hiring an advisor, this is just the list of things that we've put together, but I do think that first and foremost, they've got to be a fiduciary with a very transparent fee schedule. You know, fiduciaries are legally obligated to put your interest above their own. It's very different than brokers. Brokers can be paid a commission for things that they're recommending. And I ultimately have to ask the question, if someone's being paid for what they're recommending, is it always in my best interest or is it in theirs? We also think it's important that they're certified financial planners. We think that they need to know the ExxonMobil plans. They also need to know the IRS rules. There are some things with regards to the plans and the IRS rules that can have material impact on a retiree's plan. We believe they need to have over 15 years of experience. We also think that they need to manage their own portfolios and that they're open to discuss various different strategies. But as I mentioned earlier, they're bringing that plan back in, and that is the baseline of a lot of the decisions that are going to be made. And it's the ultimate baseline for determining success of someone's retirement plan. And then lastly, can you understand them? You know, our job is to be translators and stewards and really need to be able to interpret data in a way that you can understand and feel confident with. So that is all I had for today. I'm amazed I didn't have a single question come in. That's not very normal. But here's our contact information. And as I mentioned earlier, one of the calls to action from these events is have a plan. If you haven't taken us up on the opportunity, it is absolutely no cost, absolutely no obligation. Mindy and Sydney are going to reach out after the event to thank you for attending. And if there's any questions that I missed or that didn't come in, please feel free to reach out to me. My contact information is right there. And most importantly, stay safe, stay healthy. Oh, and if you could complete the survey at the end of this, I would really appreciate it as well. Thank you very much. Have a great day.